What if I told you that the days of affordable mortgages in Canada might be slipping away? For months, fixed mortgage rates have remained relatively stable, but we're starting to see those rates climb. Why does that even matter for the average Canadian, you ask? Well, it's not just a minor fluctuation. It's tied to deeper economic forces that impact everything from your monthly mortgage payments all the way to your ability to afford a home. In today's video, we'll dive into why this shift is happening and what it could mean for your financial future. If you're new here, I'm Cameron Brioux, and in today's video, we'll be breaking down a topic that affects millions of Canadians: mortgage rates. If you're like most people, your home is likely your biggest financial commitment, and it's the biggest one you'll ever make. At the time of recording this video, mortgage rates are on the rise for the first time in months, and this shift could have a significant impact on your budget, your home buying plans, or even the value of your property. We're going to cover why mortgage rates are going up, what economic factors are at play, and how you could navigate this changing landscape as a Canadian homeowner or a buyer. As a disclaimer, this video is for information purposes. I am a realtor in New Brunswick, not a mortgage professional, but I'm often asked questions about this topic and explaining factors that I'm going to talk about. And I always defer these questions to a mortgage professional prior to any client or person making a decision for their unique situation. So if you do need a list of pros, let me know. I can make an introduction anywhere in Canada. You can head down to the first link in the description and we can connect. Let's start with the rising fixed rate mortgages and what this means for the average Canadian. If you're a first-time home buyer, this change could mean higher borrowing costs, which could reduce how much home you can afford. If you're renewing your mortgage, you might face higher monthly payments than you expected. For many, this could mean a strain on your household budget, especially in a time when many Canadians are already dealing with higher costs due to inflation. I don't know if you've seen the price of eggs. So rising fixed rates are a signal that borrowing is getting more expensive. But in practical terms, this means that higher interest costs for mortgages are making home ownership more expensive and putting pressure on the housing market for a potential cool down. So what's causing these mortgage rates to rise? Well, it actually all comes down to the bond market. When the Canadian government issues bonds, the interest it pays to investors is called the bond yield. And that affects the rates that lenders offer on fixed mortgages. Right now, bond yields are increasing, which means that lenders are facing higher borrowing costs, and they pass those costs on to you in the form of higher mortgage rates. This matters for Canadians because the bond yields are rising. Your monthly mortgage payments will have to go up too, even if the house price remains the same. Another factor driving up bond yields and mortgage rates is inflation, which is particularly driven by oil prices. For the average Canadian, higher oil prices might mean more than just paying an extra few bucks at the pump. They push up the price of goods and services, increasing inflation across the board. When inflation is high, investors demand a higher bond yield to compensate for the loss of the purchasing power, which in turn pushes up mortgage rates. For you, that could mean a double hit: rising costs for daily expenses along with higher mortgage payments. And if you're renewing or buying a home soon, it will certainly affect you. At the time of recording, and to control it, the Bank of Canada has set an overnight rate of 4.25%. But why does this matter to you? This rate directly affects the prime rate, which is the foundation for the variable rate mortgage. If you're in a variable rate mortgage, your payments could fluctuate based on this rate. And while some relief might be coming, the Bank of Canada's cautious approach suggests that we might not see dramatic rate cuts anytime soon. For homeowners with variable rates, and maybe you're considering switching, this means you might not see the significant savings that you've been hoping for. Meanwhile, fixed rates might continue to rise, putting pressure on household budgets. Here's the bottom line. Whether you're a first-time home buyer or renewing your mortgage or even somebody with a variable rate, it is important to prepare for higher borrowing costs. For many Canadians, this could mean making adjustments to your budget or considering a smaller home or more affordable homes, or heck, even moving to a more affordable place in the country with housing like New Brunswick. I'll put this another way. Imagine you're planning a road trip across Canada. You've mapped out your route, you've got your destination set, and you're super eager to hit the road. But you're focused on one thing: finding the cheapest gas station along the way to save money. Makes sense, right? But here's the catch: you forget to check the condition of your car. You don't think about unexpected weather changes or road closures. Suddenly, cheap gas isn't your biggest concern anymore because you're stranded with engine trouble, or worse, you're stuck taking a detour that costs more money and time than you expected. Now, that's a lot like choosing a mortgage based only on interest rate. Many Canadians do this. They get caught up in finding the lowest rate. They think that it's just a number that matters. And I get it, it's tempting. It's just like cheap gas. But there is so much more to consider. What about the flexibility of the mortgage? What if life changes and you need to sell your house earlier than planned? Or maybe your financial situation shifts a little bit. These are the bumps in the road you don't see coming, and they can turn that great mortgage deal into a financial headache. So take Mark and Lisa, for example. They are a young couple in Ontario. They're excited to buy their first home. They went for the mortgage with the lowest interest rate that they could find, and now fast forward a few years, their family's growing, and they need a bigger home. But what they hadn't planned for was the massive penalty they had to pay to break their mortgage. Suddenly, that great deal is now costing them thousands, and it's more than they had expected. So what could they have done differently? They could have thought about the bigger picture and asked some critical questions. Sure, the low rate was appealing, but if they asked a few more questions like, how long are we going to stay in this home? Or what happens if we need to move? They might have chosen a different mortgage, perhaps with more flexibility. Even if the rate had been a bit higher, they could have avoided those big penalties and the financial stress. The reality is, life happens. You might need to move for a job, your family might grow, your finances might change. That's why it's so important not only to look at the interest rate, but understand the bigger picture of your mortgage terms. How long do you plan to stay in your home, and what's happening in the broader economy? In Mark and Lisa's case, if they had only thought beyond the initial interest rate, they could have picked a mortgage that allowed them to break the term without any heavy fees or even transfer it to a new property. It's like making sure your car is ready for all conditions, not just focusing on the cheap gas. By considering the bigger picture, you could potentially avoid these unexpected detours and get to your destination with peace of mind. So, before you jump into a mortgage, you need to ask yourself, is this the best product for me right now and in the future? If you found this video helpful, please give it a thumbs up and hit the subscribe button for more Canadian real estate insights. Are you renewing your mortgage or maybe planning to buy a home soon? Drop your comments and questions down below. I would love to hear how you're navigating this challenging market. All right, so rising fixed rate mortgages are putting more pressure on Canadian homeowners and buyers, and these increases are driven by bond yields and inflation and global economic factors like rising oil prices. For the average Canadian, this means higher borrowing costs and tighter household budgets. If you're making mortgage decisions, you need to look beyond just the rate and focus on flexibility and the long-term impact of that product. By staying informed and understanding the forces at play, you can make better financial choices that align with your goals. Thanks for watching, and until next time.